Hi, this is Chris Peterson, host of the Penny Forward podcast. The Penny Forward podcast is completely produced by blind-owned businesses, including Taylor's Accessibility Services. Find her web hosting services and accessibility consulting services at taylorarndt.com. That's TaylorArndt.com. Also, we appreciate you listening to the Penny Forward podcast. If you appreciate us, we hope you'll consider providing a small donation to our tip jar to make this podcast possible. It only costs a small amount per episode to produce the Penny Forward podcast, and your assistance will be greatly appreciated. Again, thank you for being a Penny Forward podcast listener.
Welcome to the Penny Forward podcast. Penny Forward is a community of people who are blind, their families and friends who share an interest in financial independence. Visit pennyforward.com to learn more about who we are and what we do. Join us now as we get to know people like us who are working toward their own success. Here is your host, Chris Peterson.
My guest today is Chris McKnight. He's a senior mortgage banker, or maybe you might think of him as a loan officer with Bank of England Mortgage. And we're going to be talking all about the home buying process, whether you're a first-time home buyer or you're selling your home and wanting to buy another one. Maybe Chris has some words of wisdom that will help you. Chris, thanks for being here.
Yeah, absolutely. Thanks for having me.
So let's talk about buying a first home, and I'm sure a lot of people struggle with this. How do you know if I can afford it?
To be honest, the best way to know what you can afford, one is, sitting down, looking at your budget, figuring out what you're really kind of comfortable with as far as a monthly mortgage payment. So one, you kind of have an idea as what you're comfortable with in that payment area. But two, then reaching out to a loan officer, at a bank, a credit union, you name it, wherever it may be. There are brokers out there as well. And just sitting down and talk with them and kind of going through really your basic mortgage application, just because there are certain programs out there and they all kind of have different guidelines as far as what they allow for debt to incomes, meaning, what kind of bills you have out there compared to, what kind of income you have coming in. So all those ratios are different for different programs that everyone might qualify for. Just because you can maybe afford a certain dollar amount or be approved up to a certain dollar amount doesn't necessarily mean that, that's a budget that you're comfortable with.
That's good advice. So focus on the monthly payment and sit down with a lender. And how do you pick a lender? How do you decide on a lender? And would you do that before going to a realtor or at the same time? Or what are your thoughts about that?
I would say, each real estate agent has their own lender that they work with. And same with each lender, they have real estate agents that they can help you out with as well, too. Really, I tell people, work with someone that you're comfortable with. Because to be honest, when it comes to the lending world and we're talking about interest rates and who's got the best rates, realistically, we're all lending from the same pool of money. There's no secret pool of money out there that's significantly cheaper with one bank than it is anybody else, and I kind of like to compare it to, those car commercials on TV where they talk about, you can have this Mercedes-Benz payment of $350, but what you're not seeing or hearing is that also includes $25,000 down and things like that. If you see something out there where rates are significantly lower than every place else, and it kind of seems too good to be true, it really usually is. And then the one thing to look at when comparing lenders is, their bank fees. Everyone wants to know, what are my closing costs? And realistically, there are a bunch of different things that go into closing costs. And really, your lender fees are only just a small portion of that, So for my bank, where we work, we just have a flat fee, no matter the dollar amount of your loan. And then again, there are third-party fees and other, fees associated with. But then there are some lenders out there that have those flat fees, but then they maybe have an origination fee out there that is a certain percentage of your total loan amount on top of that. And it's all just, each bank is just set up a little bit differently. So, really when comparing lender to lender, rate really isn't what the focus should be. It should just be, what are your bank fees? What are you charging me to work with you? Because again, rates from lender to lender should realistically be the same. Again, if you've got one lender who's at 3.5 and another lender at 2.5, there's usually something in there that they're quite not being upfront about, that, hey, here's a bunch of extra costs that you're accruing to get that 2.5% rate versus that 3.5% rate.
We'll get back to our interview in just a moment, but first...
Are you interested in investing, but the jargon has you lost? When you're in an unfamiliar financial environment and need a hand in understanding the lay of the land, Penny Forward is here to help. We provide affordable one-on-one and group education financial programs that help you get out there and achieve your goals. Visit pennyforward.com to learn more about who we are and what we do.
Do you have a short success story you want to share on the air? Leave us a message at 952-856-0313. If you missed that number, you can always find us at pennyforward.com/podcast.
You talked a little bit about a down payment, and I'm sure that's got people curious. Our parents or our grandparents all had to have 20% down. Do you need a down payment at all? And how much do you realistically need before you're ready to buy a home?
That all kind of depends on what programs we're eligible for, as far as, what do I need for down payment? Realistically, I mean, yes, you do want to have a down payment, especially in a market right now where it's crazy out there buying a house right now. There are programs out there in each state, especially one here in the state of Minnesota. And again, there are others, throughout the country as well. Minnesota has a down payment assistance program where your minimum contribution into the loan is $1,000. There's a second loan that kind of covers the rest of those down payments and closing costs if need be. Otherwise, I mean, again, because it is so tough out there, sellers are really kind of gravitating towards conventional offers, just because historically you have to be a little bit better qualified borrower to be in that conventional buying program. But they do have first-time buyer programs through the conventional program as well, where you're not maybe, getting down payment assistance, but that down payment is significantly less. So, on that conventional side, you can go as low as 3% down on that down payment. I would say for first-time home buyers, anywhere from 3 to 5% is pretty much the norm as far as that down payment goes. Definitely some programs out there as far as, help with that down payment. Also, too, depending on where you're looking, there's a USDA product out there where if you're in more of those rural areas, it's just truly a zero money down. A lot of times, too, when thinking about zero money down, really all people then hear is perfect, no money out of pocket. And really what that, down payment, that's truly just down payment. You still have closing costs on top of it. So even if it was a loan where you only have to put $1,000 in, hopefully we can help with the rest on, say, like that Minnesota housing program to help cover some of those costs, or say that USDA program where there's no down payment, but again, you still have closing costs associated with that loan. And there are ways to kind of help not necessarily roll closing costs into the loan, but sometimes people in their offers will say if a house is being sold for $200,000 and closing costs are $10,000, well, maybe you offer $210 and say, hey, I would like, I'm going to give you $10,000 more than you're asking, but I would like you to give me $10,000 in my closing cost type of deal to kind of help offset that to, again, keep as much money in your pocket as possible.
Right. So then when you do that, though, that really means that you're going to be paying a slightly higher monthly payment then, right?
Yep, definitely. And that would be something that we would go through to say, hey, I mean, a lot of times, we're really doing that for people who are in that rural area and they just don't necessarily have that savings. They can afford the monthly payment because they're paying rent right now, but they just maybe don't have that 10 grand saved up for closing costs. If you had the capability to pay those closing costs on your own, we would just kind of go through and say, here's what your total out of pocket would be. Here's what that would look like. Or if you were able to get the seller to pay $10,000 in closing costs, but again, you did increase that offer a little bit more, here's what that monthly payment would look like. Here's kind of what that break-even point would be as far as, what you got to keep in your pocket versus what you're paying extra each month.
So let's talk about the actual application process. What is it like? And then what does pre-approval actually mean?
So really the application process, a lot of times people think I have to fill this out and go through it. A lot of times when I'm doing the application process, I just do it over the phone. And really it's diving into a couple of different areas. One is going to be just your general personal information, full legal name, birth date, social, address for the last 2 years. then dive into employment history for the last 2 years, who you working for, what do you do for them, how do you get paid, hourly, salaried, commission, and then again, kind of talk about those financials, dive into, what are we comfortable with that monthly payment? What do we have in savings at this point in time? Of what we have in savings, what are we comfortable with putting down into this transaction? That's really just your mortgage application. As far as getting pre-approved, that's your first step, having that conversation with that lender, but then usually following up with sending them a couple of income documents, usually your last 30 days pay stubs, just to verify that the income that we talked about matches, and again, what I have in the system, or again, too, if you're somebody who's maybe a base plus a salary plus commission type, and I'm, trying to average out commissions and just kind of get a good idea of that. And then usually get a couple of your last 2 months bank statements just to, again, verify the assets that we talked about to show that, yep, we really do have this money in savings. And then too, depending on how much time, sometimes people are like, I need a letter and we need to send it out now. I can send you pay stubs and bank statements, and that's usually enough to at least get you a pre-approval letter. Realistically, to start the process, as far as, your basic income documents that I would have ready when getting ready to talk to a lender would be a copy of your driver's license, again, that most recent 30 days pay stubs, 2 months bank statements, your last 2 years W-2s, and then your last 2 years federal tax returns. Have those kind of documents ready. Once the lender can view those things, they're going through that, again, just verifying the things that they talked about, match on paper, then they'll issue you a pre-approval letter.
And at what point would you check someone's credit report?
Really kind of in those beginning stages, because credit scores are a big determiner on what programs we're eligible for and what rates and pricing look like within those programs. So credit score is also going to affect, we talked about our grandparents having that 20% down, which is great, but, on a $100,000 house, that's $20,000, and that's a good chunk of money. And again, not everybody has $20,000 saved up to buy a house. The one downfall of not having that 20% is you do have private mortgage insurance that, gets figured, that gets put onto that payment. That is really insurance for the bank. It's not insurance for you. And it just ensures the bank that if you were to default, that they still get their money back. It's not on the life of the loan forever on certain products, and it does fall off, but credit score, will be a determiner on that factor. The better the credit score, the lower that private mortgage insurance number. And again, the better pricing, the better rates, the better programs you're going to get with those credit scores. So usually those credit reports are good for about 6 months. So when you start the process, again, usually you don't have to repull credit throughout the process. If it's taking you a little bit longer, you might have to repull it a little bit later on, but you're not going to see big major effects by somebody updating credit score that way. I know some people get concerned when pulling up credit and they don't want to have a bunch of dings on their credit, which is true. You see that start to affect people when, somebody goes to a dealership and they're going to buy a car and then they blast you to 10 different banks, but they also just applied for a credit card through Lending Tree and sent your information to, again, 5 different banks to get you the best credit card offer. And, now you've got 10 different credit pulls in a couple of weeks. That's when you'll start to see things negatively affect those credit scores. But it would be pretty early on in that process. And really, sometimes people want to try to then talk hypotheticals without pulling credit because, again, they just don't know if they're there yet. And unfortunately, there are just too many variables in the mortgage world that we rely on that credit report, because we also use that to figure out debt to incomes and everything, that it's hard to talk hypotheticals without even having it. Even if you were to give me your credit score, it's still hard to do without knowing, what other debts and stuff you have out there. So it would get pulled on, pretty early on in the process.
I think it's important to mention here too, because a lot of people can get their credit score now through like their mobile banking app and stuff. And that's not necessarily going to be the same score. It's still a good measure of what your credit looks like, but it's not going to be necessarily the same score that you see, right, Chris?
For sure. And I would say 9 times out of 10, when I pull somebody's credit versus what they're seeing on Credit Karma or, like you said, their banking apps or whatever, I'm definitely usually lower than what they see on those apps. And so in the mortgage world, when we do pull credit bureaus, we pull a tri-merge report. So we're pulling a bureau from each report or from each credit bureau, jamming it into one report. And then in the mortgage world, we actually have to go off of that middle credit score. But yes, I would say if you're monitoring your credit, it's a great way to monitor your credit to make sure that things are reported the way they should be, balances are going, in the directions that they should be, making sure that there's no new accounts opening up or credit inquiries that are hitting your account that, you maybe didn't know about. But yeah, as far as that, looking at that credit score, using it with a grain of salt for sure.
Yeah, exactly. And don't switch from one service to another and assume that because another service is higher that your credit score is really that high. If you're going to monitor it, just stick with one, because then you can see whether it's going up or down.
Exactly.
So let's talk about then after the pre-approval, you're out doing the shopping. You've found a house you want to make an offer on, and your realtor's taking you through all that, and the seller says, yeah, you're good. We'll take that. Then what happens?
Yep. So that's really kind of then when we get to work on the loan side. We do a bunch of hustle and getting a bunch of paperwork right at the beginning so I can get you that pre-approval letter. And then depending on how long it takes you to find something, sometimes we don't really talk much for that next little bit, again, until you find something. So you get that accepted purchase agreement. I would then take a copy of that, and that's when you're going to get your first set of, of your initial loan docs. And really that's going to have rough numbers in there as far as closing costs go, and really just allows us to start the process. We have to pull things through the IRS as far as tax transcripts. You can't order an appraisal until you have an accepted purchase agreement and then those original signed docs document, because one of those is an intent to proceed. And we just really can't do anything until that initial loan doc is signed. So we get those signed, get those back, order title work, which is making sure all of the old loans are paid off and closed, and the old owners' names are getting taken off of the deed, and new owners are getting putting on, and new mortgages are getting recorded how they should be, getting appraisals ordered. And really, once we get all of those things back, along with those initial documents that we kind of talked about, we then get all of that submitted to underwriting, dotting our I's, crossing our T's, and then following up to get any other supporting documents that they need. And then really it's then just kind of getting ready for closing. It can seem pretty tedious, I'll be honest, when going through that process. And me, the lender, calling up and saying, all right, I need these information, and calling back and say, all right, I have a couple of questions, and we're going to type up this letter, and then I'm going to have you sign it, and back and forth. And there can be a lot of it sometimes, and it sometimes kind of stinks. And trust me, your lender doesn't want to deal with any more paperwork than you do, because we do it on every file that we're dealing with, so definitely frustrating. And really, we're just asking for it because, underwriters are asking for certain things so that we can get to that finish line, so you can have those keys to that, to the home.
And to put it another way, you're really looking to make sure, because you're lending a person a lot of money here, you're really looking to make sure that you can trust them to pay that back as well as you possibly can.
Yep. In 2008, before that market crash, they were clearly handing out loans to any and everybody. You could come in and you had a great credit score and you could say, make $150,000, and they just didn't care. That's what they went with. And you had your money, not too long later. And clearly it destroyed the housing market. So now there's so much more regulations and follow-ups. And again, making sure that we are lending money to qualified buyers and really doing it for people to protect them. Again, making sure that we're not putting them in a situation or a payment that they can't afford a year down the road, and now they're behind and have to lose a house.
I'm really glad you said that, because I think a lot of people kind of see the bank as being the evil bank, and they don't want to sell you a home that they're going to have to take back. That's a lot of work for them.
Right. And let's be honest, banks are great. They keep our money or whatever, but they're still a bank. They're a for-profit business, and they want to make sure too that they're not going to put themselves in a bad position.
So let's talk a little bit about maintaining a home then. And this is maybe where you get out of the way until, say, maybe you want to make an expensive repair or an upgrade. And then there are some things that you might be able to do to help, right?
Yeah. Yep. Absolutely. So like you said, kind of maintaining that home, just making that regular monthly mortgage payment, making sure you're always on time on that payment and everything. Just, as far as that payment goes, just so people know, there are couple of different things that go into that payment. One is going to be your principal and interest, just like on any loan, auto loans, student loans, credit cards, whatever it may be. And then the rest is going to go into an escrow account, which is basically a savings account set up with the servicer that is going to put money in there every month that pays a couple different things. One is going to be that private mortgage insurance. If you have it, will get paid out of that account every month. And then two is going to be your property taxes, once or twice a year, depending on where you live. Each state is a little bit different. And then your homeowner's insurance once a year, which is kind of nice because those are big chunks of money then that you just don't have to worry about paying. throughout the year. So, and then too, I guess I apologize. There was one other thing that I wanted to jump back on quick before we moved on to that, was just when we talked about, or when you had asked about ordering appraisal. A lot of times when people will buy that house, they'll order that appraisal, and that appraisal is for the bank, and that gives you the value of the house and making sure that house meets that standards for the loan guidelines. People will also order an inspection on that property, and sometimes they get those confused or think they're one and the same. And really, an inspection is for the buyer only, and they're the ones going through checking out the guts and the bones of the house. And is it a solid, sturdy house for you? Is there anything major wrong with it, or even the little things wrong with it, to say, hey, here's kind of the big overview of this house. Does it meet your standards? Is there anything back that you want to go back to the seller to say, hey, I need you to fix, whatever it may be? But again, those are two different things. It's paid for separately. It's money that's out of your pocket that doesn't go towards the loan, towards anything. I think they're nice to have, because I personally don't know, I don't know about foundations and ductwork and all those types of things in my house, but I wanted people to know the difference between the two of those. I'm
so glad that you mentioned home inspections, because I completely forgot about them. And and that's a really key thing. Yeah. I would never, ever recommend buying a home without a home inspection. I did it once because I bought a home from a family member, and I will always regret it. But let's talk about, let's go back to the maintenance now. You're in the home, you're making your payments. Those payments are once a month, and is that the only way that people can make the payments, or can they pay them on a different schedule?
Really, that kind of depends on the servicer. Sometimes people like to pay them bi-monthly, maybe part of it on the 1st and part of it on the 15th. The full payment has to be to the servicer on the 15th, just because after that, you then usually get a late payment. It's usually a decent dollar amount that you want to avoid. And definitely before the 30 days, because if they don't get the full payment within 30 days, then they'll report you, 30 days late on your credit report. But each servicer is a little bit different. I know a credit union that I once worked at, they only allowed you to do it once a month. So recommended, if you were going to pay extra, to just do it all in one payment, or to call in and have them make a special payment. I would just follow up with your servicer once you get that first mortgage statement, calling them up and kind of seeing what their options are. How can I make my payments? Can I do bi-monthly? Can I do, do I have to do it once a month? Can I go online and make my payment? Do you want it set up where they're taking that payment out of your account every month? And just see what they kind of have to offer.
Yeah, that's good advice. My servicer lets me make a payment every 2 weeks when I get paid, which I really like, but not every servicer does that. And so definitely make sure that you don't miss a payment. I mean, that is rule number one. Do not miss your mortgage payment. Yeah. And if you have to, then what?
Reach out to your servicer. Don't just let it go and think, oh, I'm just going to try to make it up and I'll just make a payment in a little bit, whatever. Reach out to your servicer and say, hey, what can we do? Here's what's going on. Whether I just got laid off or income changed or whatever, reach out to them and talk to them and just, how can we help? And again, it may be unavoidable where you're going to get to a point where it is 30 days late and it sucks then that you've got that late payment, but maybe it's just because you're getting through that process, and then they can help with maybe a deferment or something like that. I mean, with everything going on in the world and, people's jobs being lost left and right now, or, had been, I know right now you can kind of go into deferment for any reason. You can call them up and say, hey, I need to put my loan in deferment. They don't really ask any questions. If you do need to do that, ask your servicer, what does this really mean? Because sometimes really people, all they look at is I don't have to make my mortgage payment. Well, sometimes in that deferment, really what they're saying is, yep, right now for, let's say, the next 3 or 6 months, you don't have to make those payments. But at the end of that 3 or 6 months, I need all that money back. And let's be honest, 3 to 6 months worth of mortgage payments, that's a good chunk of money. And usually if you're in a position where you can't make your mortgage payment, you're really not able to give them that big chunk of money back at that end of 3 to 6 months, because if you were able to save that amount of money in that time period, you would have given them that more money, to make your mortgage payment in the first place. So usually if you have to do that, you do go in deferment, make sure you know all the details, what that looks like. And then, sometimes after you get to that point, then they'll work with you to say, okay, hey, we've got then this balance. We can't afford to pay it all right now. we're going to throw it at the end of the loan and restretch it out, or, we'll work on paying this back in the next 6 months. With your next payments, you'll make, a payment and a half or whatever it may be. They'll try to work something out with you. But yeah, I mean, just be upfront. Here's where I'm at. What can we do to make sure, do the best we can not to get behind.
What is refinancing?
Refinancing is really kind of when you're restructuring your loan, and it, can be done for a couple of different reasons. One would just be rates have dropped out. Last year, the majority of homeowners refied because rates have gone lower than they ever have before. So if you've got 4%, we refinance that loan to the current rate, and now you've lowered that monthly payment because your principal and interest is lower. Sometimes you're saving more money because you've stretched that loan back out over 30 years. You've maybe been in that loan 3 to 4 years, so you still, you've got 27, 26 years left, and you're starting back over at 30. You don't have to do that. You can structure it where you refinance, get that lower rate, and do, say, a 26-month term. I would say most people would start back over and they go to that 30. It gives people the opportunity to, again, get that lowest payment as possible. You can always pay extra every month to apply more to that principal to pay it off earlier. There's no prepayment penalties or anything like that. The other reason to do a refinance would be, we've got a bunch of equity saved up, and, maybe we want to do some home improvements. We're going to add on, we're going to do some yard work, or maybe it's because we're going to consolidate some debt. We've got some credit card debt. We've got some other things. And man, it would just be really easy if we could, lower that overall budget. It allows us to put some money in savings. And then again, maybe we put extra every month towards the principal to get that balance back down. You can do a cash out refinance for that. Otherwise, I would say the only other reason maybe to refi would be, let's say you bought your home with an FHA loan, which is a good program, has some flexibility as far as, higher debt to incomes, maybe a little bit lower credit score. On that loan, like we talked about, it allows you to go down to 3.5% for down payment, but it always has that private mortgage insurance on the loan, no matter what. Even if you had 20% equity, you still have private mortgage insurance. So a lot of times if people are in an FHA loan, when somebody's buying initially, I let them know right away up front, hey, if this is going to be a house that you're maybe going to be in for 5-10 years, you're going to hear from me in a couple of years to say, hey, let's move over to that conventional side now, because either we've got enough equity to do so, or our credit score has improved, or our debt to income has improved that allows us to go over to that conventional side. Maybe we still have that PMI, but it's going to be significantly lower just because on the conventional side, like I talked about, that number is figured out by credit score and what we have in equity in the home, versus on that FHA side, it's just a fixed percentage rate, and it's kind of a high one. So if we get you over to that conventional side, one, hopefully we're lowering that private mortgage insurance, or, dropping it off altogether. But one of the benefits of the conventional side is if you do have private mortgage insurance, once you get to a position on the loan where you've got enough equity in the loan, that will automatically fall off of your monthly payment. And then your monthly payment will just be lower, whatever that monthly private mortgage insurance figure was.
So then refinancing is basically taking out a brand new loan, right?
Yes. Yeah, I apologize. Yes. So it's a brand new mortgage. It's starting all over. You still work with your title company or with the title company, because even though ownership isn't changing, they're paying off that old mortgage, recording a new mortgage, even if it's with the same exact bank and the same exact servicer, you still go through that whole process, and it's a brand new loan. So, yep, absolutely.
Cool. Well, let's talk for a little bit about selling a home and buying another one. How is the process different?
Sometimes people will get to a spot where they're like, I'm going to buy a house first, so I've got time to move, and I'm going to sell this house, which doesn't really work out just because most people can't afford 2 mortgage payments, and you would have to approve somebody that way. So a lot of times right now, what you're doing is you're throwing your house up on the market, and in the market that it is right now, it's being sold pretty much instantly. You're going to get a chunk of change from the sale of your house, and while your house is for sale, you're going to be out shopping and kind of making offers at that same time. And we're really going to use the proceeds from the sale of your current house for the purchase of your new house, to cover that down payment and closing costs if need be. Sometimes people, they'll take all of the proceeds and put it right back into that next house. Sometimes people take some of it, put it into that house, and then they put some in their pocket because, it's equity that you've earned, and they'd rather see some of it. People are surprised a lot of times when you go to sell a house, and let's say I've got $50,000 to put down. And on that next house, let's say we're putting 5% down, and that's $30,000 for a down payment. And I'm clearly just throwing numbers out here, and that, gives their monthly payment. And they say, okay, well, I've got an extra $20,000. Like, what if I put that towards the mortgage? What's that do, for my monthly payment? Really, that $20,000, probably lower your payment about $50 a month, which is nice to have. But a lot of times, then you got to look at it as, would I rather have 20 grand in my pocket right now, or would I rather save $50 a month? And again, that's not a question I can answer. I mean, that's really just me giving you the info. Here's what both those options look like, and you making it, a decision, whatever, best suits your situation. But as far as the rest of the process, making an offer, ordering all of those things, all of that is the exact same. It's really the only thing that's different is, timing the sale of your house with the purchase of your new house, and hopefully structuring it where, you only have to move once. Sometimes people have it where they sell their house and then they don't close on their next house for a week. So they're living with family for a week, or they've got, stuff in storage for a week, or whatever it may be. But that's really the only different part is, kind of timing the sale and your next purchase and going from there. And again, a lot of times people may not have the down payment that they had saved up in the bank like they did last time, just because, again, they know that they're going to get that from the equity from the sale of their current home.
That's awesome. What if my home doesn't sell and I've got an offer on another home? Can I get out?
It depends on how that offer is structured. Normally, when you're submitting an offer like that and your house isn't sold, you're going to submit that offer as contingent on the sale of my current home. So, yep, I want an offer. I want to buy your house. Here's what I'm willing to pay you, but I need to sell my home. If I don't sell it by X date, then we'll back out. Sometimes sellers are willing to be flexible with you and say, yep, we want to sell you the house, or, we know you're good for it. We're just waiting for that person, whatever. Or sometimes it's really just, it goes back on the market, and hopefully you can get an offer, and then maybe you can resubmit your offer without it being contingent. And that's great. Unfortunately, right now in the market that we're in, just with the shortage of houses, sellers for the most part are not taking contingent offers at this time.
Do you see that market continuing that way for a long time, or do you think that'll ease off?
I don't see it necessarily changing anytime soon. At some point in time, there's going to be a housing bubble, and again, unfortunately, I don't think it's going to be as severe as it was in 2008, and I don't know when it'll be, but I don't see anything's cooling off in my perspective. Again, who knows? I mean, if I had a crystal ball to really predict this, I mean, I'd be day trading in my underwear, making buckets full of money instead. But I would say, I mean, at least for the next year, I see it being hot for sure. It's tough out there right now for anybody, I guess, to be honest with you. And it's especially tough right now for those first-time home buyers, just because really those first-time home buyers, you typically see, say, in that 250 to 350 range. And I would say in that range right now, you see houses with anywhere from 5 to 30 offers. It's wild right now. Not taking contingent offers, not taking seller paid closing costs, at this point in time. I would say it would be pretty common in the last 5 years if you were to say, put 5% down, but you want the sellers to pay 10 grand in closing costs. Like we said, maybe one, just offering them what they are asking and then still having them pay closing costs. I know when I sold my first house, I mean, that was part of the deal, that they offered me a little bit more, not as much as the closing costs, but offered me a little bit more, but they needed closing costs paid. And that was just normal at the time. That's how it was structured. And it's so competitive that they're not taking those right now, unfortunately. Or in those loan programs like we talked about, where either USDA or I guess the VA is a zero money down program as well, where I would say, I could truly do this loan for you with zero money out of pocket. Because again, we can structure it to get the sellers to pay closing costs, but it's not happening right now.
That's too bad. It helps a lot of people when that is happening. But on the other hand, if you sit around on the sidelines for a little while and save up your money, the market could cool off, and then you might have a better chance at it. And you certainly will have a better chance with more of a down payment saved up. So do that.
We'll continue our interview in a moment. But first...
Hi, this is Byron Lee from superblink.org. Are you thinking about starting a podcast but you just don't know where to begin? I can help you through the entire process. Everything from setting up your first RSS feed to editing the audio, finding music, and inserting sound effects. Check out superblink.org for more information.
Do you have a favorite budgeting, banking, or investing app? Tell us about it at 952-856-0313. If you missed that number, you can always find it at pennyforward.com/podcast.
Is there anything that you really want people to know that I didn't think to ask you?
I would say the big thing I talk to the most right now for first-time home buyers is there's just this big assumption out there that I'm a first-time home buyer. What do you have for me that's no money down? And again, like we talked about, there are a couple of programs out there that are help with those down payment programs and are good programs, or again, depending on those areas that are zero money down, they're out there. But really, I mean, for first-time home buyers, especially in this market, you know, you can take advantage of the lower money down, say putting 3% down versus say 5 or 10%. But I would say, I mean, work on that down payment. If you want to be competitive, have that down payment saved up, you know, work on having closing costs saved up as well too, because it's just tough out there. And unfortunately, I mean, this kind of sounds corny, but in going through this process, you kind of have to have the mindset of the house that's going to work out for you, the house that you end up getting is the house that was meant to be, you know? So if you're, and again, especially in this market, if you're losing out on offer after offer after offer because it is so competitive, you know, you start to get beat up. The process sucks, what have you. Really, the way to get through it is, you know, you've set the bar, you've lost it on these houses, and you just know then that next house that you put an offer on has to meet these standards or be better. And then again, when it works out, it's because it's supposed to work out. Again, corny, but it helps, especially right now. A couple of the other things that are going on right now that are kind of mind-blowing to me are, one, how high people are offering on, you know, on houses, on a house that's listed for $250, easily going for $300,000. And in that offer, writing it with appraisal waiver gaps, meaning I'm willing to pay you $300,000 for this house. Let's say the house comes in and they're willing to do an appraisal waiver gap of 10 grand. What you're saying then is you listed for 250. I'm offering you 3. If the appraisal comes in at 10 grand low at 290,000, I'm still willing to pay you 300,000. I'll just give you the difference. I don't care. To me, I mean, I personally would not feel comfortable buying something, paying more than what it's worth. Realistically, I mean, more than what the appraised value came back. Why would I pay more for it?
No, that sounds dangerous.
And some people are. Yeah, I mean, and you're not technically starting upside down like you would have back in the day where we put people on these horrible positions and now they're again upside down, or we're in that bad position when the market crashed, because you are coming out of pocket for that extra money, because the bank is not going to put themselves in that position. The bank, when you get an offer and you say, okay, I'm going to buy it for 300, we start that process as it's going to appraise at 300, but the bank is either going to use the purchase price or the loan value or the appraised value, whichever is lower, to determine what they will lend you on that property. So again, if you're willing to pay that extra 10 grand to keep it at 300, just so you know, the bank is using 250 and they're going off of that 250 number. One of the other crazy things, like we talked about, was inspections. There's a lot of people waiving inspections right now. And
yeah, don't do that.
I personally just don't. I'm not comfortable with it. I'm not a contractor. I don't build houses. I don't know what to look at, you know?
Yeah, you can always decide to ignore what the inspection reports, but at least then you know. Exactly.
You know what you're getting yourself into. You know, that's fine. And maybe it's a repair that doesn't need to be done now. And it's down the road, you know, this is going to be done. You know, kind of roughly a ballpark what it's going to be. And then again, if it's a dream house for you and it's something that you're willing to deal with down the road, that's fine. It's just something to give you peace of mind to know, if I buy this, am I just going to open a can of worms that I just can't afford later on and don't want to have to deal with?
Exactly. We got to wrap it up.
Yeah.
But I really appreciate you being here. And this was a lot of information. If people have further questions or maybe want to talk to you about getting a mortgage, how can they reach you?
My office phone number is 612-284-4104, or my cell phone number is 651-283-0685. Otherwise, too, email works as well. My email address is cmcknight, so that's cmcknight@boemortgage.com. I do work for a national lender, so I lend within all 50 states. So again, even if it's just quick questions, you know, maybe you're already working with a lender and you just want to make sure that things look on the up and up or whatever it may be. I mean, questions, concerns, comments, I mean, don't hesitate to reach out for any of it.
Well, again, Chris, thank you. I really appreciate all the information, and I hope that we can have you on again sometime.
Yeah, absolutely. I had a lot of fun. I appreciate it. I do it anytime. Thanks so much.
We hope you've enjoyed this week's episode of the Penny Forward podcast. Penny Forward is a community of people who are blind, their families and friends who share an interest in financial independence. Visit pennyforward.com to learn more about who we are and what we do. Until next time, from all of us in the Penny Forward community, thanks for listening.